Our Alpha Manager of the Day is with us, Vinay Jaising of JM Financial Services. Vinay, good to have you with us here. Thank you very much for your time. Prashant this side. You know, Nimesh put out this, we conducted a sort of poll amongst equity fund managers. And the last one was interesting. Almost 80% of those polled, when asked the question, where do they think the Nifty will be 12 months out, they said over 80% of them said above 18,000. Now, above 18 can be 18.5, 19 or 20. But 18% is less than 5% from where we are. I'm not sure whether to read that as bullish or, okay. What's your sense, Vinay? I mean, if you would ask that question, what would your response be?
So, let's look at what 18,000 means in terms of P for 1 year forward or 2 year forward earnings. If I were to take the EPS for the NSE 500 at about 830 or 40 and put a 20-time multiple, that's where we are, which is about 16,800, give or take change. If I were to move to 2 year forward EPS, we would go to somewhere close to 900, and 900 times 20, which is more or less the 5-year average, you're at 18,000. So that's the band which I think as you move towards time, based on where earnings come in, is where one has expectation. Having said that, what we are also trying to say is the Indian markets are today at 100% premium to emerging market, which has done pretty pathetically in the YTD or in the last 12 months. Though the Indian markets are, probably 1% low on a YTD basis, emerging markets are down 25-26%. So the premium, for India versus the rest of the world or rest of the emerging market has become very expensive. Hence, when life comes to normalcy, it may not be surprising to see liquidity move away from India to the rest of the world as well. Currently, the earnings look tepid. So I would tend to believe 18,000 index 12 months forward means we are basically in the +5 to -10 zone for the overall market. I would agree with that.
Okay, all right. Hi, Vinay. Afternoon. Nigel on this side. Good to speak to you as always. Vinay, upside, though, everyone's talking about. But what about downside? Do you think the markets, I mean, we're not cheap as everyone's aware of in comparison to our averages or even in comparison to some of our peers? What's the downside risk? Worst case scenario?
Yeah, so I would look at it on downside risk. Can we look back at the lows which we had, a couple of months ago? I think at 18 times 800 rupees EPS, that's a possibility of touching 15,500. The biggest risk factor, which I didn't hear much from you all, is the Forex reserves for us. Today the Forex reserves is sub $540 billion. We're losing $3 to $5 billion in a week. The currency today is at about 81.6. The dollar index is at about 111, 18% up from virtually all the global indexes. So if I were to look at me being a foreign investor and saying that, the Indian markets are flat on a 1 year basis, it's actually down 9 to 10% for me if I was using dollar. And I think that's a big concern. Come 10 to 12 weeks, come winter, and you see a little bit of crude spike up to north of 110 or $150 levels, and the Forex reserves move down. Remember, the liquidity in the banks also is in negative. We are deficit, by about 1 trillion. So all these can lead us to touching the bottoms, which we had seen some time ago. So that, I think, would be the bear side part of the story.
Okay, so the worst case scenario for the market, so the Nifty could be 15,500. Vinay, afternoon, what about the IT sector? Next week, we will have earnings from all the heavyweights, Infy, TCS, Wipro, HCL Tech, mid-caps like Mindtree and Sign too will be reporting their numbers. What should we expect?
So our perspective, whatever you're going to see in the IT sector in the next week is a function of how well the market did, or the economies did pre the war. So you won't see much of the order book coming down. Having said that, their outlook for the following 12 months may become a little more questionable. What I mean to say by that is if you look at the 2-year and 10-year chart of interest rates for US, we are at a negative 0.4, 0.5 basis points. That, in my eyes, means that the GDP of US after 2 quarters of contraction, for the next 2 quarters too, you could be at a flat level, which means the year 2022 may be a flat to a negative year for US GDP. And you'll start seeing the order book in the following year coming down. Hence, we would be underweight the IT sector as well. I'm not even getting the costs into the picture. because costs in a way may be bridged by the dollar going to about 82 or even much higher in the days to come.
By the way, look at rate gain. I think there's a huge block deal which has happened on rate gain, and it's I'm looking at some 73 lakh shares on the NSE. That's a total volume today, but and I think Nimesh had pointed this out as part of the D Street chatter that there will be a block, and that there's going to be a P investor who's perhaps going to be selling. The stock is up, what, 5 or 6% higher. 302, 303 is where rate gain is now trading at. Pretty much not at the day's highest point, but pretty close to that. The other one is Gokuldas Exports. I mean, I don't know what's happening there. Gokuldas is up 9%, almost 10% now. That's one of the largest apparel exporters out of the country, both US, Europe, etc. If you just go with industry-related news flow, you would imagine that they're kind of hurting, because for the third straight month in September, apparel exports fell and fell sharply. But I guess this is reacting to something else. It could just be, reversal after the stock had lost quite a bit. I mean, the recent high was almost 520 or so. From there, it had fallen very sharply, and today, it's coming back up. Any thoughts on Gokuldas and textiles as a space? I don't know if you own anything in that in your portfolio.
We don't own textiles as a space in our portfolio, but I would kind of link this up to those companies wherein you're earning currencies on the dollar, especially specialty chemicals or agro companies, wherein what you're doing is you're manufacturing in the country, and your end product is a high demand product in US. Then what happens is, because the commodity prices are down about 30 to 40% from peak, the outlook there looks very rosy. So one of our biggest overweight positions really is in the agro specialty chemical space itself. But the argument would be the same.
Okay, all right. Vinay, what about in terms of the money that you all are managing? Have you all raised cash in the last month or so? If yes, currently, what is your cash position? What was it a month or so ago? And if you'll have raised substantial cash, then where are you looking at deploying it?
Sure. Thanks, Nigel. So we have raised some cash. We've gone up from 10% to about 13, 14% currently. We were waiting for, the Fed hike, after which there was a risk of trade, but, it's pretty quickly coming back. So we raised cash just before that. And where we sold out to was, some of our positions, like in the auto sector, moved too high. We are still grossly overweight the auto sector. But, some of the valuations moved up a lot. And as I said, in the IT sector, we've gone underweight. So we took cash out from that sector as well. Where we're looking at deploying it, we are looking at deploying part of it in private banks, tier 1. And we are looking at deploying it in the specialty chemical and pharmaceutical space. Pharmaceuticals, domestic, specialty chemicals, where we see a good export order book coming in. But again, we won't be in a hurry to deploy it because we think the markets in the next month or two could get us better opportunities to get in.
All right, on that cautious view, Vinay, thank you very much for joining in. He expects better entry levels for the markets in the next 1 month. He likes specialty chemicals, private banks, underweight IT, and he's taken some profits off the auto names. Get into a break.